On today's episode, we're going to talk about something that potentially could be the reason why so many real estate agents struggle to hit their goals. We're going to break down the new mortgage LLPA pricing fiasco. And then we're going to talk more about the safety of door knocking. So before we jump into today's episode, if you're a real estate agent, you're watching, you're listening to the show, you're looking for coaching, you want help, you want support in building a listing focused business, and you're not at the income that you want, I'm going to put a link to our Listing Agent Academy coaching program. You can get all the details, find out if it's something you want to participate in or not. And so with that being said, let's jump into today's episode. So the first thing I want to talk about is a really interesting concept when it comes to goal setting. Now, I don't want to split hairs on, why real estate agents, why so many of them struggle to hit their goals, or why so many of them fail out of the business. I made a lot of different videos about all the different reasons. Today's conversation is more focused on the architecture, the framework in which we all set goals in the first place. And I think that you're going to find this super interesting, but more importantly than it being interesting, that you have some good concrete takeaways. So here's the idea. The idea of setting goals in our business of real estate sales, for the most part, are based on outcomes that we have little or no control over. As an example, the outcome or a goal often is in income. I want to make $100,000 this year. I want to make $50,000. I want to make $150,000. I want to make $200,000. Well, that is an outcome. That is a result. And the thing I want you to consider in this conversation is, are you in control of that outcome? In other words, if I told you, okay, put $100,000 in your bank account right now, and I snap my fingers, could you do it? Well, you would probably respond with, well, no, obviously I can't do that. You would start to tell me all the things that you would have to do in order to generate that outcome. And what am I suggesting? Well, in goal setting, the goal or the focus rather should be on those actions, those behavior, those attitudes. In other words, the leading indicators that when we do them on a consistent basis result in the outcome in which we are seeking. Now, the best analogy I've ever heard on this is this. Let's just pretend I asked you, like, this whole actions before outcomes on how to set goals, because people are saying, I want to make 100,000. I want to make 100,000. I want to make 100,000. I'm going to talk about something that we could potentially do differently that will lead you to better results. Let me give you this analogy. If I were to ask you right now, okay, without doing anything, you're listening or you're watching to this episode, and I said, increase your heart rate. Ready, go. You couldn't do it. Why? Because you can't just decide, okay, let me just think about this. All right, I made a decision. All right, heart rate elevated. You can't do it. What can you do to increase your heart rate? Then you start to come up with, well, I could run, I could jog, I could do jumping jacks, I can do push-ups, I can lift weights. I can do all of these things. And the key thing is do actions, the behaviors that lead to an elevated heart rate. Well, if that is the case, and when I think about, man, that is exactly what's happening in real estate, is that real estate agents are focused so much on the outcomes in which they have no control, like their heartbeat. And maybe, perhaps, that being the reason why most struggle to accomplish those outcomes. Let me present a different way or a different approach that may serve you in getting to the result or the desired outcome that you want. Rather than having a goal that we already talked about that we have little or no control over whatsoever, why not have the goal be the action? Why not have the goal be the leading indicator. In other words, this year, my goal is to have 7,200 conversations. That breaks out to about 30 conversations per day with prospects, past clients, center of influence, referral partners, so on and so forth. Why not make that the goal? Why not make the goal something that we have control over based on a decision, based on actions, based on our behavior, based on our attitudes? Because as we know, it's actions before outcomes. There's leading and lagging indicators. We just talked about all the things I think we would all agree on, that what we can control, the working out, the exercising, the running, the jumping jacks, will then lead to an increased heart rate. We all agree on that, right? If that is the case, why not then make that the goal? Why not make the goal, instead of saying, I want 25 listings this year. I want 50 listings this year. Okay, make that, just do it. Give me 50 listings. Or you can't. That's an outcome. But yet that is what is that's what's on our goal sheet. That's what's on our business plan. That's what's on our vision board, are all outcomes in which we have zero control over. And I wanted to make this video because I started to think about this. I'm like, it makes a lot of sense. If the goal, if the leading indicator, if the key performance indicator, the KPI, to getting 50 listings, if you work the numbers backwards, meant that you had to have 5,000 new conversations because of your current skill set, that's a goal we can wrap our minds around because it's obtainable. It's something tangible. I can have 25 conversations a day. That's just a decision. I know for sure I can make that happen. I'm in control of that. And then as a result of that being the goal, here's the key thing. As a byproduct, I end up listing 50 houses. And when I think about that, when it comes in terms of goal setting, I start to think to myself, well, maybe that's it. Maybe that is a key factor in human performance when it comes to reaching the outcomes, or when it comes to goal setting, especially in real estate sales. Hey, go on a listing appointment today. Snap your fingers, make it happen. Can't do it. You can't control whether or not that happens. What you can control is how long are you going to prospect? How many doors are you going to knock? How many text messages are you going to send? How many meetings are you going to go to? How many videos are you going to post? How many blogs are you going to write? All of those things are, in fact, things that you can control. Yes, you agree? And if so, make that the goal. The goal today, 30 new conversations. And let the results and the outcomes be a manifestation of your execution on those actions. All right, so ever since the news has released information that the FHA or FHFA has released the new LLPA pricing, the media and the housing market and the mortgage industry has just been having a field day with this. And with me to discuss this in greater detail, because I think there's a lot of, what the FHFA Director Thompson is calling misinformation is actually being taken out of context. And this episode, what we're going to talk about is clarifying everything on this whole new loan limit pricing adjustments. And so with me to discuss that in great detail, Mr. Steve Frost from National Mortgage Funding. Welcome back, my friend.
Thanks for having me, man.
Absolutely. So first and foremost, let's just, for anybody that is not aware, quickly, we'll just tee this up. On May 1st, these new loan pricing adjustments go into effect. The confusion around this is around, is the FHFA, is the government putting in pricing that helps people with lower credit and hurts people with higher credit? And that's where I think a lot of the confusion is. And so I got a lot of things I'm going to talk about, Steve. And so I want to tee this up with some stories that have come out in the last 2 days. All right. So number one, the director of FHFA, Director Thompson, she's kind of like, she put out a whole statement on what she's calling just misinformation. And so what she said was this. She said higher credit score borrowers are not being charged more so that lower credit score home buyers can pay less. That is not what is happening. And this is in response to a lot of people coming out and saying, you know, people with good credit are paying more than people with bad credit. But here's my point. I don't think that's what people are saying. I think the criticism of these price adjustments is actually the thing that's being taken out of context. Let me explain this for a second. This is what we're talking about. And I'm going to share my screen because I think this is the best way to outline this. So let me find this really quick. So, all right, let me share this. You'll be able to see this. Can you see my screen okay?
Yeah.
All right, I'm gonna highlight the section so the audience can see this. If you're watching this on YouTube, if you are listening on the podcast, I will read what we're looking at. So this is from themortgagereports.com. It isn't, Steve, at least from my perspective, it isn't that the criticism is saying that people with more credit are paying more dollars. It's the percentage that was increased. So here's what it says. It says, based on the new LLPA matrix, someone buying a $400,000 home with a 740 credit score and 20% down, aka your perfect buyer, would see their fees increase on May 1st from $2,000 to $3,500. It's a $1,500 increase in fees. Don't know how anybody can debate that. However, a home buyer with a credit score of 640 with 3% down, or the buyer that barely qualifies, will notice a substantial fee decrease from $11,000 to $6,000. Now, what she is saying isn't wrong in that the person with worse credit, dollar for dollar, is in fact paying more dollars. But what I just showed you is undebatable. You agree?
100%.
And that's, I think, where the criticism is coming from. Anybody can get a calculator and say, is this percent on 400,000 more or less? My criticism of the changes on a show that we did earlier in the week or last week isn't suggesting that people with worse credit will pay less than people with better credit. It's just what I just showed you in the audience. I think this is the greatest example of the criticism. This is the pushback from your industry, which is the mortgage industry. And this is what the president of the Mortgage Banker Association just released. He said, this is a letter he wrote to Director Thompson at the FHFA. He said that I won't highlight it. Here you go. The third iteration of changes, however, will raise costs for borrowers in the heat of Enterprise's traditional market. I'm going to talk about that in a second, and impose significant operational changes for the industry. The timing of these changes is especially troubling given current stress on the housing market conditions. And so he's talking specifically about DTI greater than 40%. And I think a lot of people, the FHFA is getting a lot of pushback on this. And I think they're taking the criticism out of context, quite frankly. Your thoughts on this?
So first and foremost, so the one for debt to income ratio, or DTI, over 40% got delayed, right? So I think they pushed that back to like August 1st. So whatever, right? I mean, you know, if you look at these, and like it's a 3/8 of a point bump at 740. At 780, credit score, that doesn't exist anymore, right? Like the
Mm-hmm.
780 essentially became the new 740, right? So a lot of people are like, well, how do I get a credit score that high? Truth be told, the credit scoring models that we use as lenders. So lenders always get the worst version of your credit, right? Like you could go to Credit Karma, you have a 900 score. You're like, dude, I got the best credit ever. I'm getting platinum Amex offers. I got everything, and then you come to me and I'm like, look, dude, your 690 is going to cost you some extra money at closing,
Right.
And so there's been a lot of changes in credit scoring. So we are seeing people that have good credit having a lot higher score, right? So I'm seeing more like 770s, 780s, and things like that. So where 740 was the baseline, the 780 is now the baseline where you're paying the lower cost. But credit scores are also tending to report higher right now, and they've changed some of that weighting around. So you have that going for you, but there's no sugarcoating this or making this look good. You were charging Fannie Mae and Freddie Mac. They went into their model and they just put it out in like some dot matrix machine, and they put all the dots where like all their loans fall based on loan to value and credit score, and they raised the prices on their biggest market. And
So
then they went up.
let me jump in right there. That's what
Yeah.
you just said is exactly what I want to show the audience. So I'm going to share my screen again. And that is what Steve just said is, I think, what people are really struggling with, including myself. And so you're looking on screen at the new pricing changes that come in May 1st. Now, I want to direct the audience attention to this heat map. And on the heat map, it shows that the greatest increase in cost. We're not saying that these buyers are paying more. Anybody can do math. We're saying that the increase of cost by borrower is right what you just said, which is the heartbeat of the mortgage industry's the biggest market, which is people that have a credit score between 720 and 740 putting 20% down, because the story goes even deeper. And so I started to ask the question to myself, Steve. I said, well, that's interesting. Why was it that those two things got the highest increase in costs out of any other borrower? Part of it was because of what you just said, in that that's where like most of the transactions are happening. So much so, I said, is that true? Is what I just said true? And I said, well, let's find out. So look at the screen yet again. And I did some research. What is the average, or how much money did people put down on the most recent home that they purchased? Ding, 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 ding. Almost 40% of the home buyers put 20% down or more. In other words, this is the largest pool of loans in the marketplace. And so anybody and everybody knows, you want the truth, follow the money.
Yeah.
So that's where my head's going at. My head's saying, okay, they went right after the mortgage industry's heartbeat of the business, which is that borrower 720 putting 20% down, which lo and behold, when you start to look beneath the surface, you start to pull back the curtain, we find, oh, that's the largest pool of loans. That's where the government's making their most money. So yes, I think it's fair to criticize the fact that those people were hit the hardest. That is undebatable. What am I missing?
You're spot on. And the other part of it is there's not a better part, right? With when you look at like as a business owner, right? And you're going to increase your prices, and you're going to increase your, one thing you look at is like, okay, where's the most of our business, right? So we've
That's
got
right.
this group of people, we've got the heartbeat of the business, right? We also say, okay, if we raise their prices and these people say, forget it, I'm not doing a conventional loan, what are my other options? FHA, not going to happen. Non-qualified mortgage, not going to happen. Oh, I'll enlist in the Army, serve 4 years on active duty or 2 years on active, whatever the VA requirements are, right? Or I'm going to do a rural development. No, they're still going to do like the conventional loan with the higher cost is still going to be their highest option. So the government, just being a business person, the government said, okay, this is the most of our business. We're going to charge them more money, And we know that they're not going to go anywhere else because this will still be the best option for them.
100% spot on. So well said. And that, I think, is what people are pushing back on. Again, going back to the heat map, that's exactly, I don't know how someone can defend that. I mean, it is clear as day that the pinpoint of the price increases, to your point, are where most people are getting mortgages. And the people that got relief, right, are the people with worse credit putting the least amount down. And I think that's the part that is raising concern for people like the CEO of the Mortgage Banker Association. Because if I'm you and I'm saying, okay, you just hit it, if most of our clientele are responsible with their finances and they have done well, it isn't that, and this is where I think people are taking this out of context, it isn't that we're saying that those people are having to pay more than people with worse credit. It's just that their increase in fees from what they were already paying, are being increased more than anybody else's. That is what is happening. That is undebatable.
Right. And truth be told, I mean, the stuff on the lower end of that spectrum. So like I have just, even yesterday, I was working on a loan site, an agent reached out and he's like, hey, I got an FHA approved buyer, not getting our offers accepted anywhere. They're looking in kind of some different parts of like an older part of Detroit. So they're seeing a lot of like appraisal issues that would come up on an FHA loan. So he sent me a 641 credit score buyer. Guy had a low debt to income ratio. He had 3% down and he had like probably 6 months of reserves in the bank. So not a ton of reserves, but from a lending standard, pretty okay. And I couldn't get it approved on Fannie Mae or Freddie Mac with as much as 10% down. So even that, that they lowered those other buckets to make them more appealing for those lower credit score buyers. The same time, the algorithm that they use to approve those loans has become more stringent. So it's like it was, they almost could have just left those buckets alone,
Wait, go back to that. Say that again. You're saying that the borrowers that these price changes are ideally, in theory, supposed to help, right? These people that are putting less down and have a lower credit score, you could see the price. The ones in green means that it got cheaper for them to borrow money, is essentially what that means. You're saying that the automated qualifying systems or the automated underwriting systems are getting harder on those same people?
100%. So like that the biggest improvement is under a 639 at 97% loan to value. So
1 3/4 points.
1 3/4 points better. That borrower, you never say never, right? But that loan is never getting approved on a 3% down Fannie Mae or Freddie Mac loan with a 625 credit score.
So wait a minute. This is what I want to challenge. If what you said is true, and I have no reason not to believe you, then there's actually more that meets the eye to this story than even I thought it did originally. In other words, here's what I just saw. On paper, maybe the administration is saying, look, it's right here. We're helping all of you people. But in the real world, when it comes time to apply for a mortgage, it hasn't changed anything.
No,
have you thought about what I just said? Do you understand what I just said?
Yeah, it doesn't do anything. Everywhere that's green on there on the bottom part of that chart is a nothing burger. It does nothing.
But on paper,
it looks better.
It looks better. And so these folks that say, okay, maybe one would look at that and say, this is awesome news. We're trying to increase home affordability. We're trying to help those that need it. Look, we are doing something about it. We being the administration. In reality, It's done nothing, is what you're saying.
No, and the feedback is like, that's an FHA buyer, right? And the reason that's an FHA buyer is not because like I want to pigeonhole somebody in that loan program, or that's a bad loan program, or that's for bad buyers or whatever it is. And I know that in a competitive market, you're always going to take a conventional offer over an FHA offer. Like that's just the way this world works. I'm totally with that. The thing is that the part that nobody's talking about in here is mortgage insurance, right?
Yeah.
So Fannie Mae and Freddie Mac have made these great changes, especially for the lower end of the spectrum. Well, a 660 credit score on a $200,000 loan with 3% down, you're paying like $250, $200 to $250 a month in PMI in mortgage insurance, and you're probably getting an interest rate. Let's just say today, say you have an LLPA waiver, right? So we won't go into the weeds now, but say you don't even have to pay these points because you're a first-time home buyer and you make less than 80% of the area median income. You don't have to pay those points. Even at a 680 credit score, your PMI is probably 3 times as much as you'll pay on an FHA loan. So it doesn't have to do with an FHA being better because of your credit score in this spectrum. It's because there's a really good chance that that conventional loans, number one, with a conventional loan, there's no we meet box A, B, C, and D, your loan's going to close, right? It's all an automated underwriting system. And there's been situations, especially in those lower tier credit, again, why they're making such a big deal out of benefiting these people would be making this automated underwriting system less temperamental, because those conventional loans, you can lose that conventional loan approval and process, and then you have to go back to the FHA, and then it messes everything. Then everybody's freaking out, So there's way more that goes into it than that. But like you're saying, that's just fluff down there, like making those things better, trying to bring those buyers in. Maybe the stuff below, if you put down 20%, yeah, you're going to get a lot. That's a nice benefit on that heat map for those lower score buyers, and it does help in conventional loans. Maybe you'll get some appraisal waivers and some things to make it easy. But for any of those adjustments above 80%, it makes way more financial sense for most of those people under a 700 credit score to get an FHA, other than in a competitive market like this where people don't want to touch FHA loans with a 10-foot pole.
Yeah. Well, here's my question. My question is, if the goal of the Federal Housing Finance Agency is to make it easier for people with lower credit to get into a home, if that is the goal, and they come to a lender or a bank, and these pricing in the new pricing model that in theory is supposed to help those folks do just that, get into more homes, isn't helping people get into more homes because they can't qualify anyways, then wouldn't that suggest that the only people affected by this are the ones qualifying for the mortgages that are paying more in fees? And isn't the revenue that is coming from all of these mortgages being originated going back to the government coming from the same people that were paying before, but now they're just paying more?
Yes. Prices got raised.
And it only affects those people that were getting mortgages anyways. And I go back to the same thing that I just realized in this conversation is it's just a mirage.
Right.
Those people can't get a loan anyways. But on paper, look, we're helping all of you guys. Us here at the Federal Housing Finance Agency, we're helping you. We're making it more affordable for you to get into a house, but you can't qualify on this. No one's talking about that, is what you're saying.
100%. And any loan officer that's been doing it for a while knows that those are FHA loans all day, and it's not because we don't like. Conventional loan is easier for everybody involved: seller, me, buyer, agents, title company. Everything is easier.
Everybody, yeah.
Everything to do a conventional loan. But when you're strictly looking, like, right, you call like a fiduciary perspective, right? Like you're trying to find the best possible terms for that buyer where they're going to pay the least amount of money for the house or make the house as affordable as possible for them. And then mix that with what's going to be like easiest for them to do at the same time. And by easiest, I mean a process where we can say up front, you are going to close at these terms, and at the closing, we end up with those terms, right? Like there's no switching. Those lower end buyers, that's the FHA loan.
So you're saying, let me just make sure I hear what you're saying. What you're saying is as a result of the changes in pricing that come into effect May 1st, does not help lower credit buyers get into homes the way that it was designed to do, and that the people that are already buying houses, it just became more expensive.
Yes, 100%.
That's it.
Yep. I mean, there's no doubt that if you are on the lower end of that heat map where it's green and you qualify, so maybe you've got a whole bunch. So lending it really relies on reserves, right? Especially for lower ends of these borrowers, like big retirement accounts and different things like that. How much money you have in the bank that you're not using toward the transaction that you'll have in case something bad happens. Like how many months can you make payments out of money that you have? That's what Fannie Mae and Freddie Mac like. The situation though is that a lot of times, in most cases, there's always the one-offs, right? But in most cases, if you have a 648 credit score, there's a really good chance you're also not fully funding your retirement, or you're not saving, 20% of your income before you pay bills, everything like that. Yeah, there's like a correlation there. It's just bad financial habits, and that may be because that's all you know, or you may have had something bad happen. And again, you go back to, okay, something bad happened to me, and we don't have the best situation right now, but we've always been really good. Well, great, you'll do an FHA loan now. We'll get you into conventional loan later. But this is a solution that is less expensive for you. And on top of that, FHA made their loans more attractive. So they lowered their monthly PMI rates, and FHA loans run at low rates. So this isn't a big commercial for FHA loans. I'm just saying that, yes, the more well-qualified people are absolutely taking the brunt of this. And that is just, it's a business move. Like, these are Fannie Mae and Freddie Mac. Like I've said before, they have CEOs, they have boards of directors, they have shareholders, they have all these things. So the goal of those companies is to make as much money as possible with as little risk as possible. Isn't that
100%.
what business is, right? And so that's what they're doing.
Yeah, this buyer right here that has a credit score under 640, that is putting 3% down, that got a 1.75% break on the cost of their mortgage, can never get this mortgage.
No, they're not getting that loan.
They got to go to FHA.
Yeah, they'd be way better.
To me, that's what we're talking about. That's the story. Yeah. Because all of this is all irrelevant anyways. And I guess I didn't realize that until literally we're just talking about it. That's the story. And bottom line, it's just the people that are getting mortgages, conventional mortgages anyways, just have to pay more. This did not do what I think their goal was, which is to help more people get into homes. That's what they're saying that the goal was. What's that?
The goal was to make more money, not to get more people into homes.
Well, that's not that's not how it's being positioned. How the FHFA, the director, comes right out in her statement on April 25th, 2023, and talks about that this is designed to help people get into more homes, to help home affordability. I mean, that's why they did this, is from my understanding. Is that correct?
Yeah.
And that's what they're saying. It's not doing that.
It's certainly not. I mean, if that was truly their goal and this is the outcome, then they have missed so badly. you know? I mean, it's like,
that's my point.
And the other thing, like I said, lenders have had, so for anybody that's watching, that's a home buyer or that's a real estate agent, and you're working with clients that are buying homes, like everything that anybody that's been pre-approved within the last 60 days this is already priced into their loan. So, right. And that's because these loans a lot of lenders put this in place because of it's loans that are sold to Fannie Mae and Freddie Mac May 1st and after. And a lot of times there's like all kinds of hangups that don't allow loans to get sold to Fannie Mae and Freddie Mac right away. Inevitably, all conventional loans get sold to them, but there can be missed documents, and maybe the lender collects the interest or servicing fees. And so there's all kinds of back end stuff that happens that may not be why a loan gets sold to Fannie Mae right away. But lenders are money makers. They lend money and they make money, and that's all they do. And they are going to look at these loans and figure out the absolute best way for them to make the most possible money is to put these fees in place long before they could stand to lose money. And so we've already seen that. I have already written loans that had people had to pay more because their debt to income ratio is higher before they rolled that back. And we ended up getting that once they rolled it back, that fee was backed out of that loan before it closed. And so they do the right thing in that way. But this is nothing new. And that's what's funny, even about the National Association of Mortgage Bankers. You read that person's letter that he wrote, like if this was something you were so worried about and you're so passionate about, and you're going to write this letter, why are you writing it now? Like, I'm just a lowly loan officer. I'm just one of the millions out here, like trying to make my way. And I've known about this since the middle of February. Like you should write your letter then before it's too late. It's all nonsense. It's all it is that FHA came out and they made a business decision to make more money on the people that use them the most. Like that's all it is.
Steve, we thank you so much. All right. So a recent article on Inman released last week said, and I quote, "These days, telling your agents to door knock for new business isn't just dated advice, but it could also be a deadly endeavor. In a world where gun violence is in our headlines daily, it's time to retire this technique for good." Well, on Tuesday, there was another article released on Inman that was written in response, which stated, "Don't knock door knocking. The benefits still outweigh the risk." So here to discuss door knocking safety, we're joined by Wendy Ledgerton. Wendy, welcome to the show.
Thank you so much. Thank you for having me. I appreciate it.
Absolutely. And I think this is a pretty hot topic right now. It seems that article has seemed to make its rounds with, I think, a lot of different companies, a lot of different forums. And so I saw your response and I reached out to you the other day. And so what was your original thought when you read the original article released a week ago? What was your original response or thoughts to that?
My original response when I read it is, here we go again, another reason to speak out against guns, because gun violence happened. And so now it's an opportunity to say why we shouldn't have guns. Because nowhere in the incidents that took place when I read the article had anything to do with our industry as realtors going out there and being a part of our community and door knocking. And so there were no stats to really back it up. And because of there not being stats and what was used, people going to the wrong door late at night, 10 p.m. at night, going into rural areas, and then today I read a follow-up and again, those stats are out there with those same information. And now they're even adding to someone getting in the wrong car. But what does that have to do with being in the middle of the afternoon, being a professional, dressing as professional, pretty much probably no one in the neighborhood, because you're going to door knock in a geo farm. And so normally you're going to be no one in that neighborhood. So what do these stats, what does that article truly have to do with our industry and knocking on a door?
Yeah, no, I mean, that's a great point. And so I think what I hear you saying is there are many, many different issues that and headlines that a lot of people are passionate about, and we're bringing things inside of our industry that are taken out of context because there's some specific nuance. Is that kind of what you're saying?
Yes, I do. And I think because the individual has a fear, and so they take that fear and they try to put it in a box, and it doesn't fit in the box for our professional industry. And that is kind of what touched for me.
Yeah. And there's a couple things that you said, Wendy, in your rebuttal or your response in the article that you wrote on Inman. And you said, "I recently read an article about the safety of real estate agents and how that fear connects to door knocking and the idea of a gun behind the door. I've researched in depth for a statistic where a real estate agent was shot for door knocking and nothing is to be found." So it sounds like you've done a lot of research. And can you kind of share with us maybe what you found?
Yeah. So what I went out and found is I researched all the stats on NAR, so National Association of Realtors. Okay. So I looked at NAR and what does NAR have out there on door knocking? And the statistics show us that the majority of incidents that happen to agents are not from door knocking, but from open houses And from going and meeting clients that we've never met before, we get a lot of leads. And from those leads, it's a new meet and greet with a person that we don't know, and so now we've learned to vet those people. Hopefully, most of us will. But we're going out and meeting people that we don't know. So 42%, I believe, was NAR's tally on that. Now, again, to go with her side of this, there is no statistics for door knocking. So yeah, I would like to see those stats. But if you look at the response to the Inman article, the first one and the second one, you'll find in there that so many people are mixed in this. So to do a true, ratio of door knocking, open house, first time meet and greets with the client, put it into perspective. And not only are we putting it in perspective, but what area are you in? Because I can tell you, I like my door knocking. You'll read in the article where I got chased by a dog.
Yeah.
That was a fun one. And I'm not young, so jumping over a fence was pretty interesting. I have been hosed down, walking up to go into a little stepped area, and someone was out there watering the yard, and I said, "Hey, it's me, Wendy. How you doing?" They turned around and hosed me down, and they were laughing the whole time. And to be honest, I see them now and I wave to them, but I do not go up to their house. So that's one of the things that you have to look at is let's get the stats out there. Maybe these articles are an opportunity for NAR or NAR to get out there and do some true statistics, because I think the follow-up article had some stats in there that truly aren't enough. I think we need more information, but also we cannot let our fears stop us from being part of our community.
Yeah.
And that's what really I touched on.
Yeah. And I want to come back to that in just a second, the community piece. But what you just touched on was, because I made a recent episode, I grabbed one of a top agent that gets most of his business through door knocking, who also read that article, and we responded to it. And he brought up that exact same point. And that is that when you look at, realtors that have been harmed in the line of duty, so to speak, it's not coming from door knocking. It's coming from exactly what you said. It's coming from open house, and it's coming from first time showings. But that was nowhere to be mentioned in the article at all. And it was just about door knocking. That's the part I found most interesting when I said, okay, there are potential risks for real estate agents in dealing with the public. Most of the time, or all of the statistics, when you actually look at it, to your point, the dangers don't come from door knocking. They come from what you said. They come from open houses and showing property to first-time prospects that we don't have a relationship with. And so the thing that I find very interesting is it's not a door knocking thing. It's safety for realtors in general. And I think we have to bring that context into this story, that it not just a door knocking thing. And I think that's what you're saying. Is that right?
Mm-hmm. Yeah, and that's exactly what I'm saying, because we had an incident in Orange County, California, where an inspector with another set of realtors and family members came to knock on a door on a property that was for sale, and there was a family feud going on. And unfortunately, the inspector was shot and killed. So those are incidences that we have to look at and we have to understand. And so we can say that may be part of door knocking, but how much of that was also not understanding the family feud and what was really going on behind the scenes, and unfortunately being the person at the front.
Yeah. What is your thought? Because I think that what you said at the beginning of this conversation is very true, in that, gun violence in America is making all this daily headlines, and we pull that into the real estate industry without giving the right context. But at the same point, if we're going to look at door knocking, well, then you can question everything we do in real estate. You have to question everything that we do. Showing property, going on listing appointments, doing open houses. And so do you feel like there are people that are suggesting that this profession become behind the technology, the wall of technology, and that we're just virtual robots? Is that kind of the feeling you're getting?
Yes. Absolutely. And that's what really bothered me about it because, and I am an older realtor and I have been in this business a while. And I feel that part of us as realtors are not just to buy and sell. And so, when we get a heated market, we get people jumping in the market saying, "Oh, I'm going to make $1 million because, that it's so easy." And it's not easy. And people learn the hard
No.
way and 2 to 5 years are gone. But the thing is that we're not just that. We're also part of a community. And a good example is there is this group of realtors in a city in Orange County that they go out and door knock and became entwined in the community. And now they do holiday events. They do a strawberry festival. They are so amazing at what they do because they are part of that community. And part of that is door knocking.
Yeah.
And people know them and people go in the grocery stores and know them. We have to be part of our community. We're not there just to be buying and selling. And yeah, that is, the end result, what we hope for. But for me, I'm a people person. That's why I got in this business. And I want to be part of those people. I want to be part of the community. And like I said in my article, one of them when I was door knocking was on an elderly woman. I'm a widow. She was an older widow. And I can tell you, being a widow sometimes can be a lonely thing. And she was lonely, and she was so excited that someone just came and wanted to talk to her that she invited me back for coffee.
Mm.
And now I've met another couple, and we go on one Sunday a month, and we go have coffee at a local coffee shop. How neat is that? And I just sit there and listen to their day.
Yeah, that's a great point.
So we really have to look at, the safety, but also, are we hiding behind our computers? Are we hiding behind technology? Now we have this chat GPT. So we're not even using our own words anymore.
Mm.
So how much is technology there to help us, but at the same time, is it taking us away from community?
Yeah, it's a great point. And when you wrote about that in your article, I said, this is spot on because I think that there are a lot of real estate agents that share that exact same vision for why they got into this business is to be a part of the community, to serve people, to serve community.
Yeah.
And, I think something interesting is, I don't think that you or anybody is saying, that safety isn't something that we need to pay attention to. But to take a statistical anomaly and take that and broad brush it across the board and say that door knocking should be banned across the board based on a statistical anomaly, there are some unintended consequences for all of the good that these things also bring to the industry. And I think that's kind of what you're saying. Is that right?
Yes, absolutely. That's exactly what I'm saying. There's so much that we can do with and for our communities.
Yeah.
Absolutely.
Yeah, and I think that's pretty dangerous to make decisions, especially in an industry like ours, in a vacuum. To say, there are things. I don't know that there are any. I don't know if there's anything that we can do, Wendy, to lower the risk 100%. I just don't know if that's reasonable. And to take a statistical, improbability and make decisions on things like that what type of society are we left with? If the risk is 1% of this and 0.6% of that happening and 0.2% of that happening, and we just live in fear, we might as well just, not leave the house, right?
Exactly. And again, we're realtors. We're supposed to be part of our communities. We are supposed to be part of the people that we work with. We're supposed to have relationship building. At least that's my perspective. Exactly.
Yeah. Well, listen, I think
Can I back up just one more thing on that?
Please.
So here's another example. I work for an investment firm. They send me out to homes where people are delinquent on their taxes.
Mm.
They will make the first call. They'll send letters. They'll get a response. They will talk to the people, and then they'll send me out as their real estate agent to meet with them. You got to see the homes I go to. Okay. And
Yeah.
so, the key thing is I go dead center in the middle of the afternoon. I dress extremely professional. And Dwayne was talking about not having a clipboard. I have a clipboard.
Yeah.
You know what I mean? And when I go and knock on these doors, these people already, have a guard up because they're losing their home.
Sure.
And I have to go and I have to very, very soft touch that. So I'm going into a neighborhood where I don't know anybody. I'm knocking on this door and I'm asking them to work with me to help them get their homes sold or allow this team to buy the home from them and help them get into a rental. So there, you want to talk about knocking on a door and having issues. And I'm a female,
Sure,
and that's one of the things I read in the article. And I think
Me
you
too.
saw some of the responses. They wanted a female's point of view. So there's my female point of view. Not only I'm knocking in a neighborhood where I know people, but I'm going out and knocking for an investment firm on very, iffy situations. But understand, I'm trained and I am protected. And I do understand, and I do canvass the neighborhood, and I know the neighborhood, and I don't park in front of the house. So there are certain things that I've learned and that I know my surroundings, and I can tell you what's behind me, left and right and forward before I even knock on that door. So it's like I said, yeah, exactly.
Are you worried about things coming into the real estate industry and being politicized?
Yes.
Yeah.
Absolutely.
And tell me about that.
I think that anytime there is a gun incident like we had, it immediately gets polarized and becomes a political point of view from left, right, even center. And I think that, as we as realtors, I believe old school, do not talk politics or religion. And I think that we need to take a step back and understand that. And because, I love everybody, and I think we need to embrace people and humans and fears and understand our industry and be professionals. And we're not there to take sides. We're there just to be part of a community and help somebody with the biggest sell they're ever going to deal with in their lifetime. Just think of the emotion behind that. Think about the emotion that I'm doing knocking on someone's door who's about to lose a property. There is so much emotion. And so let's keep the politics out of it,
Great point. I love it.
Yeah.
Wendy, thank you so much for having the courage to stick up for what it is that you believe in. We're in a world where a lot of people probably wouldn't do that. And I give you a lot of credit for responding and voicing everything that you have. And so thanks for sharing that on the show today.
Yeah. Thank you for having the show and having me on. I truly appreciate it.
You got it, Wendy. We'll talk to you soon. Okay.
Okay. Thank you so much. Take care. Bye-bye.
Take care. Bye-bye.